What's going on today? Thank you for joining us. It's been an interesting past couple of years. Doing real estate deals. I mean, it's been the place to be for literally a decade plus. But interest rates are going up, utilities are going up, insurance is going up. You know what? Not as many people are getting into real estate like it's been, but you've all built these investor bases and you've been doing deals for so long. Sometimes you got to pivot. So what we're talking about today, and we'll bring it up throughout this next year, is, just where I think the deals, the opportunities, and everything else are going to be at, and that is be the bank. You have that option between, you can have profits. Hopefully the profits are more than the interest rate. Right now, it's a little bit more difficult. The bank always gets paid. So I'm here with a really good friend, a guy that I've worked with. God, it's probably been 15 years now. Time flies when you're having fun. Mr. Oliver Austria of, is it Revolution Lending now?
Revolution Realty Capital.
I like it.
That's right. Yeah.
So, and with Realty Capital, that capital means two different things. It means equity, it means debt. There's generally, we call it the capital stack, where it's just the different loans, the different investors, all comes together to get a deal actually funded. So in your line of business, you're really just focused on the capital, not the capital, the debt side of these deals, right?
All debt, all senior debt.
All senior. So we're talking first position.
First position, secured by real estate, conservative loan to value ratios. Absolutely.
Okay. Do you ever do second? Do you ever do second?
We don't do it programmatically, meaning no, we don't do it. I think there's a time and place for it. There's some private lenders that only do seconds, and the reason for that is it's a higher yield. So you're going to get a higher return in a second naturally than a first. But our base of investors are focused on senior secured debt.
Okay. And just so that everybody understands, we're talking about this first lien position. So if there's a foreclosure and there's a sale, the money goes to pay off the first, plus the interest, plus the late fees, plus all of that before anything goes to the most important thing in the world. Yeah. I hate to say, I know that there's totally a little delay here. So we're just going to totally talk on top of each other sometimes. So you got to accept our apologies for that. It is what it is sometimes. So
we'll roll.
Yeah. We're always here to have a good time. And just to throw it out there, if you like this information, if we're nonstop doing education, sharing with the world, really how to get deals done, how to build your legacy through entrepreneurship, working with investors and otherwise. If you are interested, which I sure hope y'all are, pretty please, we'll see how this actually goes. All right, here we go. If you're interested, please go to our website, specifically crowdfundinglawyers.net, ebook number 1. It's right up here. And just so that you know, it's really just to send you a bunch of educational information. You're interested in doing investment deals, you're doing a startup, you're buying a business, you're investing in real estate. We just want to make sure that you've got complete information so you know what you're getting into before you jump into the frying pan. And sometimes it can feel like that. I can sure share and definitely want to hear a little bit more from you, Oliver. There's been some difficulties over the years in the mortgage markets, very specifically like when the interest rates go down, but now interest rates go up. Like, what changes do you pay attention to in the real estate markets for whether business is great or you're just trying to figure out your way?
Yeah, good question. The interest rates have a huge impact on the real estate market, obviously. But from our standpoint, it affects things in a couple different ways, right? So, as a real estate investor operator, someone that's going out there buying properties, doing deals, your returns are going to need to stand up to a higher bar of an interest rate, right? So, all deals that may have you know passed muster in a low interest rate environment just aren't going to work out in a higher interest rate environment. So that's number one. Number two, we're also now evaluating the exit strategy for a deal when when the property gets completed, when the property gets stabilized, or whatever the strategy might be. And so we're evaluating whether a deal can ultimately get paid off based upon some proposed after repair value, or some proposed um, you know um, debt service coverage ratio that a bank might impose on on an income producing property. So those are two big things, right? And so it's an environment where a lot of deal guys, so to speak, just are having a hard time finding deals that work. And so what does that mean? Is that the deals that do work, uh, it's a much higher competitive environment for those same deals, right? Uh,
Okay.
in our world, as a lender, we're all fighting for those to make loans on those deals that do work, right? And so it affects everybody in the ecosystem.
Okay. Well, let me ask you something. A couple of things that you brought up, just for clarity for everybody. You mentioned ARV, after repair value. Like, how does that get figured out? Does a borrower say, "Hey, this is what I think we're going to end up doing"? Do y'all do kind of an underwriting analysis of that? Who determines it for the purposes of your evaluation of a loan?
Yeah, some deals are easier to determine an after repair value than others, right? So residential real estate, very homogenous for the most part, right? So if your borrower's looking to do an infill deal in an established neighborhood, it's fairly easy to find comps, right? They're typically
Mhm.
going to say, "Hey, here's our after repair value. We're going to do our digging and making sure it makes sense, and then ultimately we'll get an appraisal that gives us a formal opinion on that." Now, if it's a commercial piece of real estate, uh, we're going to probably dig a little deeper than just getting an appraisal, and we're probably going to want to go on site to really touch the real estate to make sure that the value makes sense, the lease assumptions make sense, that sort of thing. And depending on who our end investor is, whether it's a private equity firm that's going to buy the loan, or it's a family office that we have a local relationship with, or just some wealthy individual that is looking to deploy some cash, the requirements will differ, on who determines that ARV. Sometimes a formal report is needed, sometimes it's not.
Okay. You had mentioned appraisals. I had always believed that, so please help me understand that the appraisal is what's it worth today, beyond just what Zillow may hint at, which is generally completely wrong. Will the appraisal also actually say, "Hey, if you do these things, here's what this after repair value ARV should be"?
Yeah, so the appraisal, depending on what you're hiring the appraiser for, as far as a scope, you could hire the appraiser to get what's called an as-is appraisal. What is the property worth now before anything has been done to it? And then what is a property going to be worth, assuming that we throw $300,000 of rehab into it, expand the property by 500 feet, put an addition on it, and add add a couple bathrooms or whatever the case might be. And so they'll take a look at that future scope of what that property will end up looking like, and make make a list of comps that are nearby, and have traded within the past 6 to 12 months, and compare it to those values. So depending on the scope of the appraisal, whether it's just an as is or an as is plus an ARV, will dictate what they ultimately, what sort of numbers they pass on to you. And then commercial
Right.
appraisals are a little different as well, where they're going to take a look at lease comps to and then a local capitalization rate to to determine what the value is going to be based on an income approach.
Okay. And you brought up a word, well, a couple words that I think you're very unique in the space, that literally very few of anybody has access to, and that is private equity firms. Ultimately, you're making the loans and to some extent just selling them off to private equity. Is that the case? And can you talk a little bit more about that?
Yeah, sure. So you know, when I first got in, prior to getting into the business, I was flipping homes. We were buying real estate, doing value add, reselling them. This was all in the Boston area. We typically did a single family fix and flip all the way up to converting a multi-unit building into condos. That was the play. Um, when you know at some point, managing more than one or two or five projects starts to become wieldy. Okay. And then you start, spending your day driving around, checking in on contractors, making sure that they're actually doing the work that that they told you that they were going to do. Oftentimes, it was not always, what was promised. And so that got me to the point of, what, scaling this business is going to be difficult, but the lender that I borrow money from is always getting paid no matter what. Oftentimes they were getting paid more than I was getting paid just by looking at the final settlement statement. And so that was around 2010 when I made that decision to get onto the debt side. Since 2010, the industry has grown significantly. Around 2010, most of the money that was being lent for projects, like we're talking about, hard money, private money, whatever the term is that you like to use, it was coming from local lenders, kind of
Mhm.
your wealthy retiree that knew the neighborhood and could make a loan very quickly, or it was local
Mhm.
firms that was typically well capitalized and just lent locally to borrowers that they knew. Since
Okay.
then, the market has significantly changed due to the attractiveness of the space, and it now includes Wall Street players, private equity firms, um, institutional investors, life insurance companies, and these notes, these loans are now being securitized and traded as bonds. Okay, so it's grown up significantly over the past 15 years. Uh, However,
Right.
there is still an appetite, for well, there's still room for everyone in this space. Private
Yeah.
equity occupies a certain loan profile that they're very good at doing, but they're not very good at the loan with a story. Okay, the
Okay.
loan with a story is something that resembles this guy has bad credit, but he has a clear exit strategy, and the loan to value ratio is very, very low. So there's a high likelihood that the loan will pay off without problems.
And when you say
Something
very,
along
very
those lines.
low, like what are you really looking at for your underwriting? And does it kind of come in buckets, or like, hey, if it's not, 50% loan to value, we don't touch it, or 50% ARV? Like, how do you create that scope for your own business?
Yeah, so for our fund that we have set up, it's a max of 65 LTV. So anything below 65 loan to value ratio is considered conservative in our space. Some of the more aggressive lenders in our space will typically go up to as high as 90 LTV, 90% loan to value. And the reason why they go up that high is because there's just an inordinate amount of capital that's chasing the same sort of deals. Okay.
Okay. In terms of interest rates, I mean, I remember when we first started doing deals probably around 2010. And at
Yeah.
that point, I mean, those interest rates were like 15% annualized interest. And then I know things got more competitive and that interest rate really compressed. What are you seeing out there in the market right now?
Those rates are still available, but you got to look around for it, and it's typically not going to be for the same sort of loans that we were doing back in 2010. The same loans that we were doing back in 2010 is your typical standard fix and flip loan, easy peasy rehab. We were able to get anywhere between 14% and 4 origination points on that deal. And so
Huge.
today, that same loan, you're getting lenders that will offer rates as low as 9%, for the most qualified borrowers in the most competitive states. So, for instance, our office is in San Diego, California. In California, highly competitive market, very high leverage that you're competing with against a lot of these national lenders, and rates as low as 9%. There is an opportunity, however, for loans that don't fit the institutional capital bucket, that are meant to be sold to the big loan buyers. And rates, we're currently getting rates between 12 to 13% and a couple percentage points, maybe 3 origination points. So those deals are still around. It's just a matter of being able to market yourself to do those deals. The way to look at it too is, I have a friend of mine that started a local bank here in San Diego. They're a public bank now, and I was talking to him. He said over the past couple of years, $7 trillion has left the banking system. And so, what does that mean? Without those deposits, they can't make loans like they used to
Right.
be able to before. That money has started, that money went to go to, money market funds, treasuries, that sort of thing. And so there's an opportunity, huge opportunity for anyone that is familiar with the debt space, that, is eager to learn about the debt space, to go fill those gaps in demand. We have probably anywhere from 250 to $300 million of loan inquiries coming into our office every single month. A lot of them we can't fulfill just because it's we're pretty selective, but there the demand and the need for money has not subsided.
And I got to imagine the deal size has kept getting bigger and bigger and bigger. Do you have as many, we'll call them more wholesale investors that may take down an entire loan? Or is it kind of more of, hey, you've got to throw it into your funds, you got to securitize it with multiple investors, or just sell it off to private equity? What are you experiencing today more than anything?
The residential down the middle loans, where we would need to utilize our private equity relationships, our institutional loan buyer relationships, just to be able to compete. Those terms allow us to offer as high as 90% loan to value, and rates, sub 10%. Okay. So that's that. Where we, could get higher yields is, things that don't necessarily fit in those institutional buy boxes. And what are those? Those are CRE deals. Those are deals where, residential deals where the borrower's credit, might be dinged, and is below 660, for instance. They might not have, some of these parameters that institutional loan buyers require. A lot of it's check the box items, and so
Mhm.
there's an opportunity for us to get higher yields based upon that.
And you're talking about residential deals. I know you also do commercial deals, but I do want to be very clear that when you're talking about residential projects, there actually are still commercial. They're being done as an investment. There's not somebody living in there. So it changes the regulatory landscape. Am I correct in that?
100%. Yeah. So good clarification. So everything we do is a commercial loan. It's a business purpose loan. There's for a residential property that a borrower is doing. It is a residential property, but it's a commercial purpose loan. So they would need to sign a non-owner occupant affidavit. They would need to sign an affidavit stating that it's a business purpose loan. We don't offer any any loans, any consumer loans, and everything that we've talked about thus far today is based on a professional real estate investor buying a property, refinancing a property, or doing a deal that involves a professional investment.
If and I've had clients that have had their real estate rental portfolios that they just start selling off their assets because they want to be the bank, and they carry back loans. Uh, that's more the owner occupied. That's not what we're talking about here, but it's a great way to convert from that equity to now be the bank. And you already know the properties, you already know the value. So that's been a great strategy, not including the be the bank strategies. Those same people that already have a portfolio of rental properties actually just sell it to investors, and then they keep their carried interest to manage. But at the same time, investors get that upside. I'm sure there would be an awesome way to tie in the debt deals with that. Just haven't had to, because investors' appetite for real estate has remained pretty big. It's just, as you were explaining, the top of the funnel stays big. At the end of the day, what projects actually make sense? And so what are you finding in terms of not the dollar amount, but if you have 100 different deals on your table, how many of those do you actually end up seeing get funded and closed?
So we have an appetite for residential fix and flip, residential bridge, residential ground up construction. We're a national lender, but we have a preference for some states over others. For instance, we like California, Texas, Massachusetts, Florida for different reasons. Some of the middle of the country, good deals, small loan amounts. So we prefer bigger loan amounts than others. We prefer states that are friendly to lenders. For instance, New Jersey takes forever to foreclose on a property if we need to. New York, same thing. Foreclosures in Florida in the past took a long time, just because it was just there was a ton of uh, you know uh, inventory being foreclosed upon. But you know commercial, we have an appetite for. Uh, let's see, build to suit properties where there's a credit tenant in place for 10 or 15 years. We have an appetite for. There's literally a lender for every type of scenario. I think you have, and that's the best thing about it, right? So we get requests for cannabis loans all the time. We don't do cannabis. We don't have investors that have raised their hands and say, hey, we want to make loans on cannabis. So we don't do those. Not because they're not good deals. It's just we don't have an investor base that would support that sort of thing. And so, really, what we're looking for is your middle of the road, fix and flip residential property, or your stabilized um, uh, CRE, mostly multifamily, retail, and industrial that has a clear exit strategy. So, for instance, just to kind of go back to it. So, residential under $3 million is typically an institutional product, and we are very, very. That's a very competitive space. Rates are, sub 10, maybe just a touch over 10 sometimes. CRE. we like because they're bigger loans, and they're typically income producing. So we like that for for a whole different reason. And the investors get it, they understand it. And at the end of the day, if we had to take over a property at 65 LTV or less that was income producing, we typically earmark anywhere between a 9 to 10% debt yield based on existing income. So what that means is that if someone's coming to us for a loan, there's typically income already coming in, and then if we were to ever take over, we would earmark, as far as an underwriting criteria, that we would get a 9 to 10% return on that income against our loan. And so it's very easy to explain to potential investors. Everything else, that comes in, we typically say no quickly and just send them on their way.
So I'm going to pitch you on something. And we actually haven't talked about this before, but it's what another one of my clients has been doing for 30 plus years, very successfully. And I wanted to share it just kind of step by step so that everybody that's watching here can think about, well, if I need to pivot, here may be a great opportunity for you to get into the real estate business without too much headache. You already have investor bases. So this is what my client was doing. They had a big Rolodex of investors to begin with, and they were hard money lenders. So they'd go out and originate and find the potential projects. They had a set description, all the information, ARVs, interest rates, credit information about the borrower, et cetera, and would send it out to all of their investors. And it was more of a weekly email blast of, here's the deals we have coming up. Mr. Investor, are you interested in taking it down? Or they'll securitize it between a bunch of investors so that the loans still get funded. But at the end of the day, they keep a strip of the interest rates by being able to, it's like any real estate deal. It's a carried interest for the work of finding the loan, presenting the loan, packaging it, etc. I can tell you for a huge number of people, they're so interested in doing it. They have this investor base, but they just don't have the flow of loans. They don't know how to get into the business. Bingo. Can you help the watchers, our clients, our people and deal makers of the world actually get some of that deal flow so they can build their own be the bank businesses?
100%. Yeah. So we have the infrastructure set up. We have the servicing infrastructure set up. We have the origination and the marketing for all of that. So we get deals anyways. Most of them we turn down. Having an investor base is a huge asset, as you know. And if you can turn that investor base into an opportunity to monetize on something that people are already doing, then I think that's a brilliant idea. 100%.
All right. So everybody that's listening right here that's been doing these real estate deals, and you're generally doing it for profits rather than interest rates, 2025, it's time to pivot. There's higher interest rates. So please reach out to me directly, Nate@investmentlawyers.com, or just like I was saying, go to our website, book a consultation. Happy to share more, and we'll get you some additional education on this because we're putting together a package to be working with Oliver, potentially others. But I mean, why do I need to deal with other people? You've got so much deal flow. You've been in the more wholesale space. It just makes sense. And if anybody just wants to reach out direct to you as well, whether they're originating loans, they have investors, they're looking to do deals, Kennedy, if you don't mind throwing it in the comments as well. But Oliver, how do people get a hold of you?
We're online, revcaplending.com. Pretty easy to submit deals through our website. That's literally the first thing that you see. We have a whole deal team that scours these deals every single day, and we are eager to hear from you about your deal. As I mentioned earlier, we don't do every single deal just because it's a function of our investor base plus what we have focused on in the past. But happy to have a conversation with you if you have investors that are looking for certain uh, allocation or certain exposure to some sort of asset. It's nothing but a conversation. Some lenders, as you know, Nate, are very focused on this space because they don't mind owning the asset, and so ultimately,
Mhm.
when you are senior debt and you're senior secured and you're able to lend at a very attractive loan to value ratio, the worst thing that can happen is you end up owning the asset. And so depending on how you structure the deal, depending on how you underwrite it, that might be good or that might not be good for you. And so I like to think that the way that we structure deals is that if you end up owning the asset, if we don't we don't care either way. I guess that's the point. If we end up owning the asset, it doesn't matter because we'll probably make more money. Not to say that we look to do that from the outset, but that's just a smart way of lending that you have no preference either way.
Well, realistically, I mean, that's the strategy, the vulture funds, the guys out there that are loan to own, but who doesn't want to get real estate at 25% to 50% plus off of the real value, or at least what you lent out? Like it's a no brainer if you ask me. But at the same time, these are all commercial loans, so you don't even need to think about, hey, you're kicking somebody out of the house. No, you're dealing with people that are in the business of they're trying to make profits. You're not kicking out grandma, so it's a little bit less of that loan to own fear that
Right.
can
Right.
happen.
Yeah. And that's why we stay away from the consumer loans, just because we don't have that headline risk. We don't have that, that thought or the second thought of whether we are doing something immoral or, unjust. These are all professional investors. And, you know, ultimately at the end of the day, we try to work with our borrowers. It's not a relationship that we want to be in some antagonistic relationship with. But at the end of the day, if they can't resolve the issue and get to the finish line, then we have to take action and step up for our investors, which we always do. So yeah, the thought around tying in a ready and willing investor base that does not have access to deal flow is amazing. That's something that can easily be done in a very profitable way for all parties involved, because the one writing the check typically doesn't have the skill set to source and underwrite deals. All they care about for the most part is, can I get the yield? Can I get exposure to an alternative investment that's non-correlated to traditional stocks and bonds, that is secured by real estate? And so if one of your folks has a connection to that person, that's a way to monetize that relationship through a very institutional approach, and not having to worry about whether your relationship would be compromised through a bad investment. And we've done over
Got
$1
it.
billion of these loans with little to no issues. So, we like to think that we have done a few things along the way that's helped us perfect the process. But we're always learning. We're always improving upon the machine.
Well, everybody, we're either growing or we're dying, and God knows we don't want to die. So we just keep moving forward and pivot when we need to. And that's really why I'm talking about this, doing debt deals. If something don't work, think about what's next and what's hot in the market and how to leverage and profit off that. And if you ask me, it's those interest rates right now, because it's just sexier than it's been since doing those deals in 2010. If I had an investor that they really were looking for a high interest rates, and they're okay with the second position lien risk for whatever reason, still good debt to equity. You may not do it, but would you talk somebody out of help that investor trying to get into a second position versus a first? Like, how would you respond to that?
I would, I would let them know that there are risks associated with being in a second position. Um, the second position loan structure works under certain circumstances. So for us, for instance, so we've done seconds in the past where it's not programmatic, but it's kind of exception basis, right? So um, if I were to step into a second lien situation, what do I know about the first? Okay, is it a small first or is it a big first? Can I take down the first in the event that they stop paying the first? So if it's if it's $1 million first, no problem. If it's $100 million first and I can't do anything about rectifying the situation, or at least just putting myself in a position where I protect my second, then it's something that I would have to think twice about. The exit strategy. What does the exit strategy look like? If the guy is, and this would be no different as if I'm looking at it from a first perspective or second perspective. So a lot of the same underwriting goes. Exit strategy, ability to execute, all those things would still remain the same. Uh, Generally, your exposure, you want to limit it to something that is makes sense for uh, whatever the exit strategy is. For instance, if this exit strategy is to refinance through a local bank, through a local lender, and their local lender saying, hey, we can go up to 80 or 85% of the completed value of the property, I would probably advise the person considering the second not to go beyond that, okay, because they would need to get paid off somehow, right? So I would try to limit it to 75 or 80 max if the takeout lenders can be 80, 85, right? Like I said previously, there are platforms that specialize in just doing second liens, because those yields are what makes it worthwhile for them to set up shop and have a whole operation around it, right? And then I would make sure that I step into what's called an intercreditor agreement, with the first. So if you're not familiar with the first, or you're kind of stepping in, not having done business with the first before, even if you have, it's always smart to do what's called an intercreditor agreement. It's just rules of engagement between the first and the second in case things get hairy, right? And so it allows the second to have comfort that the first is going to play ball, it's going to going to work in a collaborative fashion to solve the default issue that the borrower might be having. And so it safeguards their position so that they don't get eliminated by high default fees from the first, all kinds of crazy late fees and all these things, and the ability to pay down the first or pay off the first, or make payments on behalf of the borrower in the event that the borrower um, becomes later delinquent or some sort of maturity default. So there is a time and place for a second. I would not talk anybody out if they were really looking to do the second for the purposes of higher yield. I think it's certainly a good strategy. You just have to know what you're doing.
Love it. So, interest rates have been going up. We all hope that interest rates come down. Kind of unique in the world. Interest rates go down, the values of loans actually increase. So if you make $100,000 loan that you have a 10% annualized interest rate, then the market goes down to 6% interest rate.
Yeah.
Can you actually sell the loan for more than what you initially lent out to begin with?
Yeah, so interest rates dictate a lot of things in our space. So the play, just for the listeners that are interested in getting in the space, um, a common strategy is to originate a loan at X percent and then sell it off to one of these loan buyers at X% minus Y. So for instance, originating a loan at 11% and then selling it off at 10%. Over the life of the loan, the interest rate spread that that 1% gets paid to you in the form of a monthly coupon, right? So that's that, right? So in the specific to your question, we originate a bunch. So, one thing that we haven't talked about is we originate permanent financing loans for rental properties and portfolios of rental properties. And so we'll typically originate these and hang on to them until we have a decent amount, and then we'll sell them off to the secondary market. The way that, that world works is if we originate a loan, for a single family rental property at 8%, for instance, and rate, the market interest rates go down, from the time that we originated the loan down to say 6%. To your question earlier, we can sell that loan at a greater premium than what we may have been able to sell it to a loan buyer had it stayed the same at 8%. And typically, how these are these get structured is that when you sell the loan, you sell it for what's called par plus. And so let's just say you make $1 million loan, and so par plus would be, if the value of that premium went up from 101. So 101 would be, you would, once you sell, you get the $1 million back, plus you get 1% of that $1 million. And so in that example of, rates going down from 8% to 6%, your premium may now be, 103. And so when you sell that loan in a lower interest rate environment, you could sell it for $1 million, getting your principal back plus the 3% that some loan buyer would not be willing to pay for. Now, the opposite also holds true, where if your interest rates went up, the value of that loan would go down, and so your ability to sell that loan, for a profit, goes down, and you might have to sell that loan at a loss. And so a couple of years ago, when interest rates just kind of spiked up, that happened to a lot of originators that were holding on to loans, waiting to accumulate a pool. And then when rates spiked up, they were forced to sell these loans at a loss, sometimes 98, 97, 96, depending on the severity of the interest rate difference. So playing that game can be a little bit dangerous because of the interest rate risk.
Well, however, and speaking to the deal guys of the world, if you think interest rates are going to continue going up, don't do this. If you think that interest rates will be going down at some point, you may want to start collecting these loans so that you can sell them actually for that premium. And that's what was asking about. I'm sure hoping for, with the new administration, new president that is very real estate friendly, that we start to see those interest rates go down. 100%. I mean, he's out there doing deals, and he's there to make sure that it's a healthy market for you to do deals as well. I'm so excited for the next 4 years for what it's going to do with real estate.
Yeah, likewise.
So let me, something else that you mentioned, and it's literally the only reason why anybody would want to get into this business. Well, they can originate, get an origination fee, move on. But if they're working with investors and bringing stuff together, they want to have their own coupon, or their own strip of the interest as it comes in. Can you speak a little bit to, like, I know it's a little different if you're handling everything, but to build expectations, if I help put together a 10% loan that I give 8% to the investors, is that kind of the way that it works to still get carried interest, or could you speak on that a little bit?
100%. So there's so that works for nearly all structures, right? So unless you're just brokering a loan and getting a finder fee, So there's a spectrum of setups in this world, right? So in California, we have trust deeds, not mortgages. So we have what's called trust deed investors. These are the guys that are writing the checks to make the loan. And then typically, what you have with trust deed investors is you have um, these licensed brokers that will arrange a loan, find a loan, um, service the loan, and they will get compensated for that. And so, in a 10% example, where you make a loan for 10% to a borrower, it's commonplace to be able to earn a 1 or 2% servicing fee for the life of the loan, in addition to the origination points that are collected. And so you don't have to have your own money. You can market yourself as one of these capital advisors or brokers that are finding and arranging and servicing the loan, on the behalf of these investors that have the funds to go deploy. Um, the there's also, obviously, you're familiar with fund structures where you have you're the manager of a fund that of a debt fund that goes and places these loans, from you find investors to come into the fund, and then as part of your compensation for doing everything that is involved in running a successful fund, you're going to get your management fee, you're going to get your carry. And so that is kind of your that is very similar to how working with a trustee investor might be. Obviously a whole lot more structured to it, but it's typically the direction that most people go once they're able to find a little bit of success, with managing 1 or 2 investors. It just gets wieldy over time
Mm.
um, after working with trustee investors without any sort of formal, kind of structure and being able to raise funds. So the name of the game is cash flow, right? And so I think that's what you're alluding to, right? So if you have a base of investors that you can go help them successfully deploy their hard-earned capital, um, you know the model is typically to get an ongoing fee to be able to you build up amount of cash flow every single month, and that's earned through placing, arranging, and servicing the loan over the life of the loan. And
Okay.
whether you're doing that through just trustee investors, or whether you have a more sophisticated fund structure, the model is the same on how you're compensated.
And let me just throw out to everybody a couple of things to really think about. Um, I hate having high preferred rates in funds because you never know what's going to happen with the interest rates in the future. You don't want to just be working for the investors at the end of the day. You're only doing it. Well, big part of the reason is because you want to benefit, create your legacy as well. So I definitely, if you're doing a fund structure, prefer a profit or an interest split rather than higher preferred returns. A little bit different than like doing a traditional multifamily syndication where you may have a higher interest rate. So I did want to throw that out there. Also with the, hey, watch out, there's all kinds of regulations involving everything that we're talking about, whether it's securities, whether it's broker dealer, meaning you're selling investments. There are these considerations. So pretty please don't just jump out there and start doing deals. Make sure you're working with a good attorney. Would love it to be us crowdfunding lawyers. Don't care. You have to have an attorney. Make sure you're staying out of trouble. There are headaches out there, and I don't want you to have them. Let me
Yeah, that's good
ask you
advice,
about.
by the way. Sorry, I just wanted to comment on the no pref comment. That's actually how you set mine up, and I thought that was very smart, because interest rates can move, and depending on where interest rates go, you could be stuck in a scenario where you are just paying the pref to the investors. Good for the investors, bad for the manager. So that was that was very smart.
Well, we've got a saying: you can't live off love. It doesn't keep the lights on. So yeah, make sure that you're making money all along the same way. Again, it's just how you're structuring them, how you're doing them. And if you have a smaller fund, and I know that you've done this over the years, I don't know if you're still doing it now, you can literally recycle the money within the fund. You make the loans, you choose your strategy to liquidate, sell on the secondary market, sell fractional interest or lower interest rate, the loans to third parties, but be able to recycle the money within your fund so that it just builds on itself. It becomes more of a derivative that you may have sold the loan, but you still have some piece of it. So I want to throw that out because I know it can be huge. Oliver, I don't know if you could speak a little bit on that.
Yeah, optionality is great, right? So, over the past few years, everybody has been falling in love with private debt, private credit. Not even just in the real estate space, but investors have really come to love the debt structure. As far as our space, we're always real estate secured, senior debt, as I mentioned, and there's never there's never a limit to the appetite for the loans that we write from loan buyers all across the country. And so even if you have a small fund, you can still recycle that capital by selling that loan on the secondary market and then replenishing your dry powder. And you can keep doing that over and over and over again. Buyers are out there. Buyers are making themselves known. They have a mandate to go deploy capital. So I think having optionality as far as where that loan goes, whether that stays in your fund on your balance sheet or that loan goes and gets sold to one of dozens of institutional loan buyers out there. And the institutional loan buyer, it's not just the institutional loan buyer, it's family offices, it's debt funds that don't have the infrastructure to originate. So you can literally get started in this business with a small amount of capital. Today's technology at your fingertips, you have the ability to do public record searches, for instance, and know who all the borrowers are in any particular county across the country, and then call upon all those borrowers that did deals in your area, and then offer them your services. And then a lot of times, by the time that you have a healthy inventory of deal flow, you can meet that demand for capital by getting set up to sell your loans onto the secondary market. You're obviously going to need to have some small amount of capital to fund the loan at the outset, but even if it's just a few $100,000 to get you started while you continue to raise capital from investors to sign on as in the subscription. You can either sell in single loans or pools of loans at a time. So the industry has become sophisticated and it's grown significantly over the past 15 years since I've been involved.
So we've got a question here, and if anybody else has any questions, throw it in chat. We've got a few minutes left, but definitely don't want to ignore anybody. Thanks for the questions. Start where you can. The question is, how much does it cost to set up paperwork in order to offer a real estate loan? I can tell you from the setup side to bring in capital, there's so many different strategies. It really is what works best for you and your investors. So, hey, John, I still like to start where you can, but I appreciate you, John. Just reach out to us, go to crowdfundinglawyers.net. Happy to walk through what the options are. We just charge fixed fees, and I think we're too cheap, but better for you. However, on the flip side of doing a real estate loan, I know there are services out there that you don't have to hire an expensive attorney every time you do a loan transaction or do a deal. And they kind of help you out coast to coast, regardless of what state. Could you speak a little bit to the actual documentation process of making a loan?
Yeah, so the documentation, I'm assuming the question is what you're asking about is loan docs, actual loan docs, the security instrument, the promissory note, all the various documents that we would need in order to make your standard type of loan. The short answer is it kind of depends, but it can
Are you
be
an
as
attorney?
low as
Because that's our answer to everything. I just literally, John, it depends. So sorry to interrupt you.
Not an attorney. I've seen a lot of attorneys on TV. So the so I'll start with a residential loan. So a residential loan, there's services out there that you can do. You can get set up and do a set of docs, and it'll cost you a few $100. Now, the caveat to that is that you got to know what you're doing. You got to be familiarized with all of these docs. You got to be familiarized with how to review title and how to do all the things that are necessary in order to actually close the loan. So, and it costs more money as the docs get more complex. And so, if you have numerous signers and there's numerous properties that are securing the loan and there's different jurisdictions, then it can get more complex. So I've engaged with attorneys that, well, not attorneys, but I've paid anywhere from $500 to $18,000. That's the range, depending on what type of loan and what the need is. Um, if you're new, it would behoove you to consult with an attorney that can handle everything from A to Z, can help you understand what's on the what's on the prelim title, what sort of things need to be kind of resolved before closing the loan. Um, and then the important thing to understand, lastly, is that the borrower always pays for those fees, and so it's very commonplace for the borrower to to pay the fees related to the loan. And depending on how complex, how sophisticated the loan request is, it is very commonplace for them to pay a lot of fees. So that's the important thing to understand. You will never have to defend, how much the loan docs are or how much uh, the attorney services are for someone that gets it, understands it, and has been there before. Now, to the investor that you're representing, assuming that you have an investor that is deploying cash with you into this loan, um, it's important to make sure they're protected, because if they are protected and all things go right with the loan, they will be back around the second time, the third time, the fourth time. So the important thing is to make sure that they feel like they're protected, all the bases are covered from A to Z, so that you don't have to explain why something was missed.
And at the same time, you absolutely have to be educated, work with somebody that has experience like a mentor, or work with more of a professional organization that is looking for long-term relationships like Oliver here and his Rev Capital, whatever. I know you've had this company over here, you've had that company over there. You never stop growing, building, pivoting with the markets. I think it's comical that it's all just Oliver Austria land.
That's right.
It doesn't even matter what the companies are called anymore.
That's right.
So we've only got, it's just you, and I know you got a big old team behind you as well.
Yeah.
But we do just have a couple minutes here. Do you have any final thoughts or advice that you'd like to share with anybody that is looking to do deals, looking to bring money to the table, looking to get into the business?
I would just say that it's the debt space is very it's very unique. The I was having a conversation with a borrower the other day, one of our borrowers that has done very, very well for himself over the past few years in multifamily. Now, currently he's feeling some pains about higher interest rates and whatnot, and so we were just having a chuckle about the difference between debt and being an operator, kind of the guy on the ground, buying deals, doing deals. And so his position was very envious a few years ago. Today, he chuckles. He'd rather be slow and steady and have built a business based on debt over the past few years. So what I can say about the debt space is that it can be very consistent. There's always going to be a need for debt and a guy that or a team that can really kind of help you understand the capital market space. And the beauty of it is that if you're able to gain the trust and respect and relationship of either an investor that is writing the check or a borrower that is needing your services, they're going to be with you for life. And so, we're not making loans to, some homeowner that's going to live in the house for the next 10 or 20 years and never need a loan again. Some folks in our space are doing, multiple deals a month. And that is a huge business. What's up, Brendan? B Money.
It's been a little while. I remember him from way back in the day.
Yeah. So Brendan is crushing it in California. He is he's one of the biggest lenders in California right now. Arizona, I believe, is his market as well. So that's actually it's interesting that he just popped up. He is a testament to what I just said. He's been at this game for a very long time. One of my very, very first employees, as a matter of fact, and he's just taken California by storm. So I'm very proud of him.
Love it. 15 years later. All right. I'm throwing your email into chat. What was your email again? Totally forgot.
Oliver at revcaplending.com. If you have a loan request, send it to loans@revcaplending.com.
Oh, no. They are going to bug you.
Damn.
All right. I'm going to throw my email on there as well, just to make it nice and simple. And then I got to share something with you. And you're going to love this. All right. So, we've always been making T-shirts and whatnot. I don't know if you got this in your Christmas present, but we got our crowdfunding lawyers beanies now. Sent them out to all our clients. I'm hoping you got yours as well.
You know what? I didn't get it, but I expect it in the mail. I will say that I wear your crowdfunding shirts to the gym every single morning. So you're getting a lot of love from the 5:30, 6 a.m. crowd.
Love it, and I'm sure it just smells wonderfully. But Kennedy, for God's sakes, get this out to Oliver and any other clients that we missed. I appreciate you, Oliver, showing up today, just sharing so much great information. We got to do it again, and I can actually guarantee it because I'm going to continue to pitch you on this. Hey, send your loans out to everybody that is creating these opportunities, working with us to create the platforms, to bring the investors in, to fund more loans. So, Oliver, we're definitely going to chat again soon. Appreciate you, everybody.
Love it. Yeah, thanks for the time. Yeah, this was fun. All right, thanks, everybody.